Joining me now with reaction, Eugene Profit of Profit Investments and NewEdge Wealth's Cameron Dawson joins me right here at Post 9. It's great to have both of you with us. You'd think there's more downside ahead, and you've been pretty negative for a while now.
Yeah, I think that there's a fundamental and a technical answer to that question. The fundamental one is that we do think that a recession is likely sometime in the next 12 months because of the speed and the magnitude of Fed hiking. But the market's not pricing in a recession, whether it's with the earnings or the multiple. They're still rather positive. The technical answer is that we remain in a downtrend, and we have had rallies, but they've been rather anemic, not really led by that pro-cyclical risk-on trading. That would tell us that we're still in a downtrend, lower highs, lower lows. 3,400 is kind of the number that you're looking for? That's where we start to get really interested from a fundamental perspective. That gets you back down to the pre-COVID high.
And that's 10+% from here down.
Yes, but that would take the total drawdown to about 30%. Down. That's on average what we see during recessions. 30% down, about 9 months of length. So at some point, we're getting rather close, and this correction will have run its course.
Eugene, if I'm looking for somebody to counter Cameron's negativity, apparently you're not the right person, because you think we're going lower too.
But I can counter it. I think that basically if we do go down 10%, it's going to be in those large cap tech companies that have yet to decline significantly. They'll just be confirming what the rest of the market already has, that we're in a bear market. We've had that 30% drawdown in a lot of other names. I do think that there is a recession risk. I think that the interest rates going higher will definitely be impactful. And then with earnings coming around, I believe the operating margins are going to really be the focus. I think companies have been able to pass the prices on, but they have higher input costs. And on top of that, I really think Delta was a very good example of what we're going to expect to see the rest of our earnings.
You think, Cameron, the pain trade for tech too is lower?
Yeah, if we look at tech earnings specifically, we see that those estimates haven't get cut. They're still at 14% for the year. Yeah. And we've actually seen some of the most extreme inflows into tech compared to outflows out of other areas like energy and financials. Of course, financials being more beaten up. But if we think about tech, because earnings haven't gotten cut, we have to ask a question about the dollar. Tech has the most exposure to non-U.S. earnings of any sector in the S&P. It's about 60% of their revenue.
Yeah, we already heard from Microsoft, a month or so ago, warning about that. Now, we haven't really heard from that many others. Your suggestion is there's a lot more that's going to take effect because of this strong currency. You know, you got the euro basically at parity with the dollar.
And they're going to try to pull every lever that they can to not have to cut estimates. And you heard Google last night talking about pausing on hiring. And so there's definitely starting to belt tighten. And I think we have to ask the question, we saw a lot of earnings resilience in the last recession in COVID, but that was really unique. It was a lot of pull forward of demand because of being in lockdown, stuck at home. Does that repeat itself when we see broad companies maybe cutting back on capex in totality?
Eugene, where does the Fed factor into the way you're thinking now? And look, I mean, I get the fact Bostic's not a voting member, but nonetheless, when a Fed president is willing to at least entertain the idea of 100 basis points, you got to sit up and take notice. And I'm wondering if they did that, or who knows, an intermeeting move, what the stock market would do.
Well, I think you're right. You do have to pay attention to that. But I think Fisher might be more on point that it's going to be 75 basis points because the Fed is still figuring out what the impact of these increases are. And they don't want to overshoot too quickly. And you do see some moderation. If they come at 100 basis points, a lot of market participants think that, you rip the Band-Aid off, get it done, and we can be off to the races. And in July, you're running away. I don't think that that's quite the case. I think that them going intermeeting or 100 is actually more fearful than not. I think that if companies really are talking about we have more revenue, but we have less profitability, and analysts have not really downgraded those earnings estimates, that's where the pressure is going to come from the market. And I think in that case, we probably are lower than we are right now.